Good morning, all. My name's Anthony Appleton, and welcome to BDO's financial reporting update for this summer 2021. Now, I'll be joined by Elisa Noble, a senior manager in my team, and by Moses Safati, who will sit in the background and will be ready to share any questions you might have with Elisa and I as we go through. So. I'm the partner in our financial reporting advisory team, and both Elisa and Moses are colleagues in my team. If you have any questions as you go through, please add them into the Q&A, and Moses will be monitoring these as we go through, and hopefully he'll be able to share your questions with me as we proceed, and we'll be able to answer them as we go through. If you have any questions that we haven't had a chance to answer in the time, well, we will come back to you directly with any further responses. So if we can make a start, this should last us around 35 to 45 minutes, I should think. So let's see what we'll be covering. Firstly, I will have a look at the interim reporting, and in particular, the FRC's recent thematic review of interim reporting that was recently issued. This was looking at interim reporting during the pandemic phase, pandemic, and so clearly there is a focus on the kinds of issues one has seen recently: going concern, impairment, that kind of matter. But what I would say is the lessons drawn from that, the items of good practice they've identified, are equally valid for annual reports, and also equally valid for reporting whether within or outside the height of the pandemic. So lots to learn from that. I'll also look at a few IFRS changes and some other current reporting issues. I'll then pass to my colleague Elisa, who will give you a more detailed update of some recent IFRS and UK GAAP changes, and then finally I'll come back for a little bit on some other financial reporting news, the implications of the Finance Act 2021 for accounting, a little bit about developments in the UK and Dawson Board. We've covered this before, but this is the board that will be taking over the endorsement of IFRS for the UK, rather than as historically we've had to rely on European Union endorsement. And then finally, very hot topic, no pun intended, but an update on climate change and sustainability reporting. So we can move on. First of all, as I say, first topic is interim reporting. Clearly relevant for those of you with June interims to prepare, but as I say, if you don't yourself produce interims, I think the lessons learned that we can draw from the FRC's thematic review equally valid for annual reviews as well. So what have they found? Well, first thing is, overall the FRC were really very pleased with the quality of interim reporting. And so I think this thematic review, which you can easily download from the FRC's website, is very easy to read, very accessible, and full of kind of practical examples of good practice. Is well worth pulling down if you the quality of your reporting, you want to focus on what does good look like. But in terms of an interim report, what we can draw from this is some particular expectations for what does a good interim report contain. Firstly, the management commentary. That's the front end of an interim report. In an annual report, clearly it'd be the strategic report. But for an interim, what they're really looking for, what important events has the company faced in the first 6 months of the year? And what's changed? Has there been any restructuring? How has COVID affected business? Has there been any refinancing? These significant events, both in terms of financial performance and in financial position, that need to be explained to provide a context really for the numbers in the back end. We expect to see principal risks and uncertainties updated. and some indication of how these risks and uncertainties are expected to develop over the rest of the year. Clearly, we are in a period of lots of uncertainty as we come out of the lockdown, as the government support is reduced over the coming months. How do we expect the business is going to be able to respond to those events? APMs always been a matter of great concern and interest to the FRC, and especially since ESMA, the European Market Authority, issued guidance a number of years ago, and this is certainly something we've covered on past webinars. But at its heart, the key elements of that guidance is, if you're using APMs, explain them, allow people to understand why this measure is being used and exactly what it represents. APM should generally be consistent from year to year, but I can certainly see how in the current phase there might be some new measures given, but that should really be the exception rather than the rule. Explain what they are, and that should be sort of a consistent rationale for why these are needed. They should be reconciled, so reconciled to the accounts have been prepared in accordance with IFRS. Allow people to understand how this differs to the numbers reported in the primary statements, and get the balance right. Yes, in many cases, management will really do consider that the ABMs are better measures of performance, perhaps, than those in the financial statements because of the way they see their business. But it is a requirement that these aren't given undue prominence compared to IFRS. So get the balance right. If you're going to be discussing the APMs, also be discussing the implications at the IFRS, using IFRS measurement basis. Now, one area that we've had to put a lot of focus on recently is going concern disclosures. And the FRC were really genuinely quite impressed with the level of disclosure, which has really shown how companies have thought carefully about the uncertainties they face, the uncertainties ahead of them, and in this time when performance could have been quite dramatically hampered, how the future, what their assessments are of the ability to continue to be a going concern and the material uncertainties that might affect them. Well, what have they particularly liked? Well, it's about disclosures around the going concern process, the assumptions that have gone into the cash flow forecasting, and the sensitivity of that forecasting to the uncertainties we're all facing. And also importantly, the use of stress testing and potentially reverse stress testing. Again, these are things we've featured in past webinars, but right now, being able to flex those budgets and understand where the stress points are and what changes in the future compared to expectations would start threatening the going concern assumption. So explain what's being done, explain the assumptions, and explain the sensitivities of the conclusions to alternative scenarios. Another area where the FRC is always interested in is around key judgments and estimates. And in the interim, it's about ultimately how have these changed since the annual report? How have things changed? How have the expectations changed? And where's this led to changes in the accounting? I think one thing to bear in mind is they will expect to see some level of consistency in those assumptions, the discussions of the future, their impact on estimates across the risks and uncertainties, the going concern disclosures, and accounting elsewhere in things such like impairment reviews. Yes, there will be some differences because for an impairment review, the judgment should be based on facts and circumstances at the balance sheet date, whilst going concern assumptions must be updated for all subsequent events and changes in expectations. But still, there should be an underlying consistency and that allows a sort of clear narrative to be provided to users. Other things, events and transactions with material impact. So, not surprisingly, where there's been transactions that have in themselves had a material impact on the financial statements, they should be explained, and those impacts, the requisite disclosures given around those. And finally, an interim report is by necessity shorter than an annual report. It always is. But whatever we're providing material disclosure, these should always be clear and concise. Get to the point, allow the user to understand fully the situation, and focus on those material disclosures rather than clouding them, which can happen when we just try to speak too much about more immaterial items. So moving on to some more of the detail from this, some of the things we should be thinking about. So yeah, the management report, especially the commentaries about performance in the first half, and those material matters that have arisen, those transactions you've entered into. And some of the things that particularly highlight, is explaining significant movements in the balance sheet. One example might be a defined benefit scheme liability. There's been significant swing since the year end. The balance sheet has moved quite dramatically there. We would expect the management commentary, the front end of the interim review, to provide an explanation of that. They've generally found that the management commentary covers the performance well, but less well the need to explain the movements in the balance sheet, and with explanations of cash flows being somewhere in between. Focusing on those APMs again, just to reiterate, and explain why you've used them, reconcile them to GAAP measures, get the balance right. But also, above and beyond that, explain any kind of exceptional items, any material, any single line items you have pulled out, you've focused on them as being important items in the financial statements. Well, if they're important there, ensure that the management report also explains what those issues are, why you consider them to be in some way exceptional, why you have pulled them out for particular attention. In terms of the going concern, well, hopefully we've all learned in this period, I think, to improve the process around going concern assessments. The focus we've all had on it, I think we've all actually just got far better at the process of assessing whether a business is a going concern. Explain this too. Now here I'm talking about within the financial statements, but focusing on the assumptions, focusing on those matters which are of particular significance, such as covenants, such as the availability of future finance facilities. What are the material uncertainties that cast significant doubt on continue to be a going concern? So picking up on these, explaining them, and providing the appropriate context. As I say, the much of the financial statements are based on the information and the facts and circumstances at the balance sheet date, and indeed the expectations at that point in time you had for the future. Well, things may have changed since then, particularly, thinking here about changing liquidity, changing solvency. So ensure we've explained those movements since the balance sheet date. Finally, on this slide, impairment of non-financial assets. Again, how do the assumptions, how do the things we're explaining there link to the assumptions made in the going concern and develop the going concern assessment? They will differ because the going concern is more up to date, but the underlying assumptions should be consistent, and if not, explanation as to why things have changed. Back to what I said on the going concern disclosures. Moving on. Cash flow information is an area where investors are particularly interested in right now more than ever, because of the stresses and strains we're facing in terms of our liquidity, and our ability to change to have sufficient cash to continue to meet our debts as the fall due. So, you know, right now there's probably a need to go beyond the base ISO and what you might normally have in an interim review, explaining more of the disclosures similar to those that are provided under IS 7. And, you know, as we're entering into sort of periods of refinancing, or we are making commitments to those who are providing finance, this could well be leading to changes in the availability of cash and our ability to use it. So that, and for whatever reason, one thing they've focused on is disclosing any changes in those restricted cash. Just an estimate. Well, in times of uncertainty, you're going to be making more estimate, there's more uncertainty. You know, we're going to have to be using estimation methods more often, or new estimation methods. You know, providing explanation of those to really give specific detail that allows a user of the accounts to put the measurement into context. And one other thing, the FRC do stress that there's a difference between a judgment and an estimate. If you look in IS1, you'll see they're covered by separate paragraphs. You know, when it comes to judgment, these are the things you've had to think about to determine the appropriate accounting treatment. You know, is a lease, let's say. Whereas estimates are the things which drive the measurement when there is uncertainty. So keep in your own mind that these are different concepts, different phenomena, and IS1 has different disclosure requirements, and the FRC do focus on that. Finally, income tax determination. You know, there's always an issue in interim reporting. We know tax is a little bit more complex when we do interim reporting. So, you know, good examples of interim reviews really explain how the income tax has been determined and how, you know, significant offence have impacted on the treatment of tax. Moving on. So that's what the FRC had to say about interim reviews. Some of those messages you may have heard in one form or another for a number of years. It doesn't stop them being important. You know, the FRC continue to be concerned about a sensitivity analysis around judgments, around APMs, around explanation material items, material transactions, whether we're talking about this year's interim, next year's interim, any year's annual review. So I think, you know, have a look at, download that report, because it does give you lots of good practical examples. I think the final slide for me on this, on looking at the interims, is just to see about a few IFRS amendments that are applying for the first time, or will soon be available. IFRS 4, this is only for insurance companies, because IFRS 17 was deferred. Well, so was the adoption for insurance companies of IFRS 9. Next one, this may well have a more broader scope. Again, we've covered it previously, but just a very quick recap. As we move away from LIBOR and other interest rate benchmarks are being changed, the ISB have had to provide sort of transitional help, if I can put it that way, change the standards such that as we transition from LIBOR to SONIA or other rates, the normal accounting requirements don't create necessary disruption in the accounting. So this is around things like ensuring that when you do make the move, it isn't considered to be a modification of a loan, which would bring in part of IFRS 9. And as you change your hedging documentation because you've moved from a derivative based on LIBOR to a derivative based on SONIA or something else, again, that doesn't disrupt the hedge accounting. If you have had any of your financial instruments re-benchmarked during the period, you really need to think about what this is and how you deal with those changes, because while smoothing out the accounting disruption, it does also set certain disclosure requirements for you. So if you've got any LIBOR rated loans or derivatives, please do think about what the impacts that's going to have and the disclosures that are necessary. Finally, an amendment which isn't yet effective but is certainly available for early adoption by some is the amendments to IFRS 16. We had the amendments last year to deal with COVID-19 related rent concessions. What they've now done is extended the backstop date to June next year, sorry, to June 2022, such that if the rent concession extends beyond the old backstop date of 2021, they now fall in the scope of the amendment. We've got a bit of a dual track process going on here. If you're preparing accounts which are in accordance with UK adopted IFRS, it's available already for early use. The UK and Dawson Board and the Secretary of State have already adopted this, and so it's available for use in the UK. If, however, and so if you're preparing interims for a December year, for a June year, a June 6-month ended period, this will be available for you. If, however, you are preparing accounts for a full year ended June, and you're still forced to apply UK EU adopted IFRS. Well, the EU haven't yet adopted this, so you need to wait for them to do it. We've talked before about the complexity of the transitional rules, and there is ways that you can adopt pieces of the UK endorsed standards in certain situations. Not going to go through all of that right now, but think about that again, because if you are required to apply purely EU adopted IFRS, then this isn't yet available for your use. And I think that's it for me. I will just pause for a second though and ask Moses, was there any questions coming through? Moses?
Sorry, I was just unmuting myself. No, nothing come through at the moment, so I think we can move on to the next section.
Thanks a lot. Again, guys, if anything comes through, any questions you have, please pop them in the Q&A and we'll try and answer them if we can. But for now, I will pass over to Elisa. Thanks, Elisa.
All right, thank you very much, Anthony. And what we will look at next is a few recent changes to IFRS and UK GAAP. So these are slightly more detailed technical changes. So the first item is an amendment to IAS 12 income taxes, which the IASB issued recently. This one hasn't yet been adopted or endorsed by UK EB or for EU IFRS, so we'll have to wait for that. But just an initial explanation of what this is about, and it is one that's a little bit complicated to understand. So this is looking at deferred tax accounting for transactions where you recognize both an asset and a liability at the same time at the inception of a transaction. So the most obvious example of this, and why it has come up recently, is in IFRS 16, a lessee recognizes a right of use asset and a lease liability at the beginning of the lease, and those may, for example, be for the same amount. Another example that comes up, we see it frequently in for example, the natural resources sector, is for decommissioning liabilities, decommissioning obligations, where you're recognizing a provision under IAS 37, the provision standard, and the other side of that entry goes to the balance sheet. So as part of, let's say, your property, plant and equipment. So for these transactions where you recognize both an asset and a liability, there was a bit of uncertainty, bit of divergence in practice, diversity in practice for how do we account for deferred tax. And so what this amendment to IAS 12 does is it comes that the initial recognition exemption does not apply, and therefore you do need to potentially recognize deferred tax assets and liabilities at the initial recognition for this type of transaction. So some companies may have had transactions they didn't recognize deferred tax for before because they thought that the initial recognition exemption applied, and now that will no longer be the case going forward. Now, we do have a publication that explains this in more detail with some examples, but we are also in a minute going to take a slightly closer look at how this works for leases in particular, since this is a bit confusing and complicated potentially. So this is effective periods beginning from 1st of January 2023, subject to endorsement. Early adoption is permitted if disclosed once it's been endorsed. It doesn't work on a fully retrospective basis, so you don't sort of have to work out as if it had always been in place. Instead, you go to the beginning of the earliest comparative period presented and recognize deferred tax assets and liabilities at that date, with any differences going to opening retained earnings. So let's take a look at how this applies for leases. So if we think about it, if you recognize a right of use asset and a lease liability under IFRS 16, or in fact the situation would have been similar under IAS 17. Can everyone hear me? I'm getting a message on my screen saying my internet is unstable, but I hope it's still sounding okay. If someone could let me know if there's a problem.
There's just some very intermittent little breaks in the audio, but I think it's sounding okay again.
Okay, sorry about that. Okay, so back to IAS 12. So if we're recognizing a right of use asset and a lease liability, to think through the deferred tax, what a company needs to do is consider what is the tax base? Do I have any temporary differences which IAS require me to recognize deferred tax for? So what then is the tax base for your lease asset and liability? Now, this depends on the tax law in the jurisdiction in which the company is operating. And this is where it can get quite complicated, because different companies and different tax jurisdictions give companies tax deductions in different ways for their leasing arrangements. So in some cases, the sort of simplest situation is where the tax follows the accounting and you get a tax deduction for the depreciation and interest expense which you have in your accounts. If that's the case, then you won't have any deferred tax to worry about accounting for. And we are not tax experts in the technical accounting team, but my understanding is that at least some UK companies with IFRS 16 in their company accounts are in that happy situation. However, not everyone is, and this can be for many different reasons. You may have international groups with subsidiaries in different jurisdictions with different tax rules that you need to account for at group level. Under IFRS 16 and IAS 12, you may even have UK subsidiaries that are doing FRS 102 accounts at the company level and maybe getting a different type of tax deduction. So in reality, I think there are many companies who are getting a tax deduction payments rather than what's going through the accounts. And if that's the case, then this complicates the deferred tax, and it could be that you have a temporary difference in deferred tax. What this diagram on this slide is trying to explain is figure out whether the tax deduction relates to the asset or the liability. So if it relates to the asset and so basically you're getting a deduction for depreciation and interest, then if that's the case, the tax will be equal to the carrying amount of the of the right of use asset and liability in the accounts, and you won't get any temporary differences, and therefore there's no deferred tax to account for, at least at that initial recognition stage. If your company's accounts are working in that manner, then this amendment doesn't change anything for you. Then probably nothing is changing for you there. If, however, the situation is that it seems that you're getting a tax deduction related to the lease liability, which I think is a common interpretation if it's based on the timing of when your payments are lease payments are being made, then what this means is that the tax base is 0, and that then does give temporary differences, and in theory, IAS 12 requires you to account for deferred tax. Now, based on the current understanding of IAS 12 as it's currently drafted, many companies have in that situation a partial recognition exemption. And this is a specific part of IAS 12 which says that okay, you don't recognize deferred tax in situations where oh, okay, sorry, just reading a message there. You don't actually recognize deferred tax when you have a transaction that doesn't affect accounting profit or taxable profit at the time of the transaction, so long as it's not a business combination. And so they haven't been recognizing deferred tax initially or later. So for those companies, this amendment is relevant, and you now will need to think about deferred tax, because what the IASB has done is redrafted the wording of the initial recognition exemption and said that that doesn't apply to this type of transaction where you have equal taxable and deductible temporary differences at the initial recognition. So such companies would need to recognize deferred tax. If you can just go on to the next slide, please. Not going to, you can look at these slides later, they'll be circulated in more detail, but what the next 2 slides do is set out for a really simple leasing example, what your assets and your lease assets and liability would be. Next slide, please. So basically to illustrate that with the amendments to IAS 12, you would see deferred tax assets and liabilities recognized based on the temporary differences, based on the carrying amounts, which would not have typically been recognized under the previous version of IAS 12. They may qualify for offsetting, and if that's the case, then you'd sort of get a net deferred tax asset going forward if you look at that sort of 4. So something to look into if you've got a lot of leases or things like decommissioning obligations. Okay, what have we got next? The next one is an IFRS Interpretations Committee decision earlier this year on the topic of cloud computing arrangements, and specifically certain costs that companies might incur at the outset of such arrangements, so customization and configuration costs. So why is this important? Quite a lot of companies nowadays have arrange for IT services on the cloud. So that means IT services provided over the internet rather than hosted on your own premises. And in particular, software as a service arrangements are ones where software applications are delivered over the internet. Now, sometimes when you sign up for this type of arrangement, companies incur quite a lot of costs because they need to sort of configure their systems in such a way that the software application can work for them, and it may also need to be customized so that it works as it needs to. So 2 years ago, the IFRS Interpretations Committee looked at the general question of how does a company account for cloud computing costs, and do they give rise to an asset on the balance sheet? So could it be the case that there's a lease, or could it be the case that there's an intangible asset? Now, in that decision, they reached the conclusion that generally speaking, no, typically you don't control this type of software asset, and therefore these are typically expensed as a service contract. This time, what they were focusing on is those customization and configuration costs, because it seems there might be companies who've been recognizing assets on the balance sheet for these costs. And basically what's happened here, if we go to the next slide, the interpreter reached a conclusion that typically these wouldn't give rise to intangible assets, and in many cases actually need to be expensed. So that as such is a relatively broad conclusion worth bringing to your attention. Apart from the conclusion, is that this decision ended up taking up a lot of discussion, and they also set out some very detailed steps and considerations for how companies, how you would reach this conclusion. So they looked at both of can you recognize an intangible asset, and if not, then how do you account for these types of arrangements? We actually have an online training module on our website which goes through this in detail. There's a link on the screen now, so you could look at that. If we just take a look at the next slide, please. So the reason why you do not recognize an intangible asset for these types of costs is because the customer generally does not control the software or create an asset that could be considered separate from that software when they customize or configure it for their own use. The exceptions would possibly be if in the process you're creating sort of additional code and you really have the clearly the power to obtain the benefits from that and to restrict others from accessing it. So if only in some very narrow situations, the IS 38 recognition criteria. On the next slide, then, we have some of the thoughts that the Interpretations Committee looked at when they said, well, how should you account for such costs instead? So if generally speaking, if you have a service contract, then how and when should you recognize that? I think there's been a bit of diversity in this area, and quite a lot of people tend to think of the matching concept, which may not be the right thing to do. So what they said is that you should recognize the costs as an expense when you receive those services. And when you receive those services is when the supplier provides the services. And if it's not obvious when that is, then the suggestion was to look at IFRS 15. So we're actually looking at costs here, but the Interpretations Committee suggested that companies look to the revenue standard for guidance on the timing of when the services have been performed. They also suggested that you think about whether the service is distinct. So is it distinct from the rest of the software as a service provider? If it is, you receive the customization and configuration services. If it's not distinct, though, there could be a situation where you could maybe have a prepayment and recognize the costs at the same time as the rest of the software as a service arrangement. Thought that you need to think through exactly who's providing the situation, and the analysis might be slightly different, and depending on whether it's the software as a service provider, the entity itself, or third party who's providing those services. So if that's relevant to you, then I'd recommend looking at that in more detail to see if there's any change in policy needed. On the next slide is just a sort of advance notice of this is not an amendment yet, and it's not even an exposure draft yet, but recently in June, the IASB indicated that they intend to revisit an amendment that has been made to IAS 1. Some of you may remember this. It was issued in January 2020 on the classification of liabilities as current or non-current. So this looked at rewording the requirements for that. And now it was originally effective for 2022. So some of you may already have been looking at implementing this and whether it will change anything for you, but it was actually deferred by a year to 2023 last year due to the pandemic. And it's worth noting at that time, this was because it was thought that companies might need a bit of time to look into this and potentially to renegotiate things like some covenants or loan agreements. And then there's been quite a lot of discussion on how exactly it applies for different situations, particularly for loans that have covenants attached to them. So things like financial ratio covenants. And the Interpretations Committee looked at it, and there were quite a lot of concerns raised from various parties. And this has resulted in the IASB deciding that they're going to revisit the requirement. So at the moment, they're proposing to move the effective date yet further by 1 more year, and to look at changing the requirement in respect of debt with covenants, and possibly introduce some additional disclosure requirements about any debt that is subject to conditions. Now, the concern is particularly situations where where the right to defer settlement for at least 12 months is subject to conditions, but those conditions are sort of relevant after the reporting date. So you might have a covenant test coming up after the reporting date. So the first version of the amendment is really extremely strict as currently drafted for this, and it's possible that it looks like they'll be revisiting this. So this is just something to be aware of if, for example, you were looking at refinancing or renegotiating any covenants, then the rules might be changing again on this. Okay, just last couple of updates, very minor or small items of news. So UK GAAP, we talked about this last time. So the leasing, there is an amendment to FRS 102 for rent concessions, which is similar to what Anthony mentioned under IFRS. So there was an amendment last year for rent concessions. The one in UK GAAP is slightly different to the IFRS in that it's a mandatory rule for rent concessions accounting. They must be recognised for in the period that they're intended to compensate. And so this was also for rent concessions due by 30 June 2021, and that's now changed to 30 June 2022. For January 2021 periods onwards. Okay, and the last item on the next slide was just that the FRC has completed another review of FRS 101, the reduced disclosure framework, and the news here is that there isn't a lot of change, only one further disclosure exemption to align one of the new requirements for IAS 16 on proceeds before intended use for IAS 16, and then really just some minor wording changes for consistency, but not a lot of change for FRS 101 preparers. So I think that has that brought us to the end of those accounting updates, and I'll pass you back to Anthony for a few other pieces of news.
Thanks, Lisa. Yeah, I don't think there's any other questions coming through. So yeah, quick run to the end now. Just firstly, the Finance Act. Obviously, we always have to wait for the changes to be substantively enacted. Well, there have been now. And so we now need to be using these new rates for deferred tax calculations. Excuse me. won't go through the detail of that, but I think that hopefully that's self-explanatory. Another thing that was in there though was the new 130% super deduction to incentivize investments in qualifying plant and machinery. This would generally be considered to have two parts. There is a standard allowance used in the determination of deferred tax, but the super deduction is effectively an investment tax credit, we believe, and thereby, because it's there to incentivize investment. Now the accounting for those is partly a function of the GAAP you're under, and partly a function of whether you intend to sell the asset. If you don't intend to sell the asset, then this will be kind of seen as a permanent difference. However, if there is an intention to sell, because there is a clawback, then it will need to be considered in your deferred tax calculations as well. We won't go through the detail here, but because I think we've covered enough deferred tax for one day. But certainly, if you're going to be taking that super deduction, you need to think through the accounting consequences. And as I said, different whether you're under UK GAAP or IFRS, and different depending on what your future intentions are. And so then, just moving on. Very quick point. We've talked about this coming. It's now up and running. The UK and Dawson Board has had the relevant powers delegated to it by the Secretary of State. So from now on, the process for, in the first place, influencing the development of IFRS on behalf of the UK, but as new standards are issued or amended, their analysis and endorsement decision will all sit with this UK and Dawson Board, which is now fully operational. And then finally, just a little bit of an update around climate-related disclosures. This is if you like, the big topic in corporate reporting right now. The developments and the press towards going to the towards sustainability standards is a global one. It is fully backed by IOSCO, the global association of organization covering all market regulators, securities regulators. It is backed by the UN, it's backed by national governments, and so we are certainly going to see much change over the coming years. At one level, we've already seen some things. So we've spoke previously about how premium listed commercial entities are required to make TCFD disclosures at the end of this year, so for December 21 year ends. The FCA are now consulting on extending that to standard listed issuers of shares and to other regulated entities such as asset managers, life insurers, etc. They're consulting about bringing that in for next year with some phasing over time, and we can certainly expect that. I think they will go ahead with those plans. At the same time, we see this kind of quite clear trajectory towards TCFD. We can also see on a global stage a new board in development. So I'm actually moving to the left of the slide now. But the IFRS Foundation that sits above the ISB is working to set up a sister board, the International Sustainability Standards Board. And we can expect that to be in place before COP26 at the end of this year. We can also expect there to be the first exposure draft this year of a standard on climate change and climate-related disclosures. There's already a prototype in circulation. This was developed by the current major players in this area, who are the Sustainability Accounting Standards Board, the International Integrated Reporting Council, the IRC. But they've worked together to issue what they think could be a prototype future standard. And the same group are currently working and with the IFRS Foundation on in a working group, which is there as the precursor to the new Sustainability Standards Board. So there's full steam ahead towards there being something before an exposure draft before the end of this year. Now that won't automatically become mandatory for the UK, but given the backing of IOSCO, the backing of the UN, the backing of the UK government to the development of this board, I would expect this to be something that will be incorporated in the first place, perhaps by the listing rules, but beyond that in UK legislation. And we're seeing a lot of repositioning of the current major players. The middle point there says about how the IRC and the SASB have merged to create something new, the Value Reporting Foundation. And in a way, that's the first step of the consolidation. Those who try to report on this will find that there is a myriad of standard setting bodies out there. It's difficult to know which to follow. It's difficult to know what is required. And the purpose of this process is to end up there being one defining set of standards that would both drive the demand from investors, but also the requirements being set by national regulators, so we can all coalesce around one set of requirements. And that will be the first step. Climate change disclosure will be the first step, but then we will see other sustainability reporting standards over the coming years. I am certain. Right. Well, I think that brings us to the end of the presentation. But I understand there is a question out there. Let me just. Moses, is that right?
Yes, there is one question, and well, I'll just read it out here. It's are companies encountering issues from the disclosure of their use of government subsidies in connection with COVID-19, and how are these best addressed? I think if you want my view, it's about transparencies, and it's about looking backwards to tell stakeholders what you have received, but also if you're looking forwards and you're going concern and you are planning or you're counting on receiving government assistance, that there's disclosure of that and clarity on that as well, so that a user can understand how much you've used, but how much you're planning on using. But over to you.
Yeah, I'd fully agree, Moses. I mean, the FRC themselves have highlighted that the use of government support during the pandemic is probably an issue that's material by nature, that users, investors are particularly interested in the use of this support and the extent to which it's been necessary, the extent to which it's been relied on, and the extent to which once it goes, there will be concerns around, issues around going concern in the future. So yeah, are there issues? Yes, because I think there's sometimes a sensitivity about making these disclosures and perhaps an initial reluctance to do so. But I think it is certainly an area the FRC are expecting to see disclosure on. And I think, to fully provide an understanding of financial performance now and the impact on financial position in the future, I think such disclosures are going to be necessary. So yeah. So if that is all, I thank you for your attention.